Dealmaker Insights, the podcast brought to you by Reed Smith's corporate and finance lawyers from around the globe. In this podcast series, we explore the various legal and financial issues impacting your deals. Should you have any questions on any of the content through this series, please contact our speakers.
Hi, I'm Justin Hunter. I'm an associate in Reed Smith's Transactional Tax Group, and with me is...
Hi, I'm Rishi Jain. I'm also an associate with the Transactional Tax Group.
And together, we're going to be talking about the taxation of cryptocurrency. I want to preface that we're not going to get into the weeds of what cryptocurrency is, but we are going to focus on, I think, what I would say is three distinct issues involving cryptocurrency and the resulting tax consequences. The first one is, how is cryptocurrency, or what is it, I guess, characterized for tax purposes, U.S. federal income tax purposes, that is, and the differences between what we call proof of work versus proof of stake, and how proof of work and proof of stake are taxed. And then finally, we're going to look at a major point, crypto lending, and how a lender of cryptocurrency will be taxed under U.S. federal income tax principles. To begin, I think we need to look at the different pieces of guidance that the IRS has issued on cryptocurrency. There are three, basically, as in there's very little guidance out there, which kind of makes cryptocurrency the Wild West of taxation, is the way I would look at it. There's a lot of open issues. The big one that the IRS, I think they thought they answered back in 2014, or did the best they could, was they issued a notice, 2014-21, in which they concluded that virtual currency, they called it, is property for U.S. federal income tax principles. Now, I'm going to bring in Rishi here to talk about that a bit. But essentially, that seems obvious to most people that it's property. But what does that distinguish from? I think Rishi, I don't know, I'm looping you in here, but they're basically distinguishing, in my view, from money, like straight up cash, and a regular currency.
Yep, I would totally agree. And before I get into Notice 2014-21, let's be clear. As with many things in the federal government, the economy and the markets move much faster, and sometimes the government is a little slow on the uptake to determine regulatory constraints for these new movements. So I think recognizing that fact is why we have such limited guidance at this current juncture. Getting back to Notice 2014-21, Justin's exactly right. The big takeaway is that for U.S. federal income tax purposes, virtual currency is treated as specifically tangible personal property. And what that means is that for all intents and purposes, if I'm selling a coin of Bitcoin or a coin of Ethereum, it's treated as if I actually possessed a coin of Bitcoin and sold it to someone else for an amount of money. And when we think about that process, that transaction in which tangible personal property is sold, it's a very basic concept. Under Section 1001, your gain, if you hold the currency and you decide to sell it, is going to be your amount realized over the basis that you had in that coin. And the basis in that coin is essentially going to be the fair market value of it at the time you bought it in the first place.
I agree with that, Rishi. I view it as like a barter. It's like we're going back in time to when we didn't have currency, and you would trade a mule for, a sword or whatever. You know what I mean? And that's kind of how cryptocurrency is getting treated here, where if you make a transfer, you pay for something in cryptocurrency, you pay in Bitcoin or whatever it is, you recognize gain on the Bitcoin that you transferred to someone else as payment for a service or a good, which, you wouldn't really think about that in the concept of when we're typically paying using credit cards, or, basically all credit cards now, but sometimes cash, and you just pay that amount. It's $5. All right, I'm paying $5, right?
Right.
If you paid $5 in Bitcoin, if you bought that Bitcoin for $1, you'd have $4 of gain you're recognizing that's taxable.
Right.
which I find it it's a very interesting way to look at it, because we just think we're just doing, if you're doing a straight up transfer for a service or a good, you just think I'm paying 5 Bitcoin and that's it. I'm done with it, the transaction.
Right. And speaking of services, because this has become a big thing, I think was it Odell Beckham Jr. that wanted to take his salary in Bitcoin?
Yeah.
Compensation.
When it was $69,000, just for
Yeah,
the
right.
Not the 22 it's currently trading at.
Yes, this podcast is also very appropriate considering the crash that's occurred in the last couple of days. Compensation for U.S. federal income tax purposes, when it's paid via a currency, is recognized at the fair market value at the time of receipt. So if you were paid in Bitcoin and Bitcoin is valued at $100 on the day you were paid, that is your income inclusion for purposes of federal taxation. And that doesn't matter whether it was worth 50 the day before or it's worth 20 the day after. But what matters is at the moment you got paid, what was the value of that coin at the time? And I think that's an important concept because given the volatility of Bitcoin, you don't know what your impact is before and after. And it's one of the reasons that Odell Beckham Jr. got himself into a little hot water with getting paid in Bitcoin and suddenly finding himself wanting as far as the salary that he originally had negotiated for.
I also want to point out that people consistently think of, well, it's called cryptocurrency. Why is it not treated as a currency? And the simple answer to that is, at least prior, I think, to 2021, is that it was not any other country's national currency, not their, coin and paper. That has now changed. El Salvador, I think last year, made Bitcoin one of their national currencies. Now, It's technically speaking, because it is a virtual currency, it is not their paper and coin. So you could still argue that it shouldn't be treated as currency for U.S. federal income tax purposes, principles. But you can certainly see a new argument now that maybe because someone else has done this, has made it a national currency, that it should be treated as currency. And the reason why this matters, though, is because property, like a house, for example, is treated differently under the tax code compared to currency. Different provisions affect it. And the reason why, and so if you think, well, okay, so we've answered the question like the IRS did when they said we're treating this as property, funny enough, it gets even more in-depth than that, because then it becomes, well, not only now we know it's not cash, it's not currency. We're going to treat it as, those are the big three: cash, currency, and property. But then there's basically a subsection of property where it's either, is it a commodity or is it a security? And the IRS has not answered that question in the 3 pieces of guidance that they've issued.
Speaking of, Justin, before we get to that next subject on commodity versus security, I'd be remiss if I didn't just mention that the other pieces of guidance that Justin's referring to is a series of FAQs that expanded on 2014-21 that were issued in 2019, and you can find them on the IRS website.
They're not binding. Don't forget to mention, they're not binding. They're FAQs.
That's right.
That you can use for your personal return, and then the IRS can turn around, I guess, and say that they're not binding, and you don't. What if you have a position that they don't like? They don't have to follow.
Yeah, don't quote the IRS when you go through those FAQs. And the other big one is a revenue ruling that was also issued in 2019. I believe
2019-24, I believe, is what it is.
Thank you, sir. And it's, without going into too much detail, because it was sort of widely panned as not being a great ruling, I do want to note that in situations where there is a hard fork of cryptocurrency and you receive currency as a result, like in a few years ago, Bitcoin had hard forked into Bitcoin Cash, and some people received new Bitcoin Cash depending on their holdings of Bitcoin. That would have been included as an ascension to wealth and therefore taxable for U.S. federal income.
I like ascension. I think it's accession, but I do like ascension better.
Thank you. You make me feel real good, Justin.
You're welcome. I do prefer ascension. I would like to ascend.
Yes, that's right.
Yeah, it's certainly interesting that revenue ruling, and I'll just briefly touch on it. But that That was the IRS is definitely giving. They were really trying hard to try to analyze. And I think these transactions, by the way, that the cryptocurrency do, they're complicated. And basically, they were trying to analyze, well, what happens when you have a hard fork? In these types of transactions, a hard fork can be two different types, which you could have a non-contentious. Classic example of a non-contentious hard fork was Ethereum, handful of years ago, I believe, where they had a hack on their blockchain, and the people lost a bunch of coins. And so their non-contentious hard fork, which is basically, I would view this in simple terms, as if you went from Windows 10 to Windows 11, kind of a concept where everyone's fine with, all right, we're going on to Windows 11, sounds good. I don't know if what'll happen in the future, but at least I know, they're making some upgrades to the system. This is kind of how I would view a non-contentious hard fork. It's just a massive software upgrade. And in this case, what they did was actually I think it was like a time revert, where they basically made a fork in the road where now all the coins that the new fork is effectively as if the hack had never occurred. That's a non-contentious hard fork. And a contentious hard fork is if you have basically a bunch of developers who can't agree as to what's happening with the server, the protocol, however you want to describe it. And so they break off in pieces. They break off in an actual fork. You have one chain that goes another direction, the other chain goes the other, right? So now it's a true fork, I would say. And the IRS was trying to explain what would happen if you, as a result of going through a hard fork, you received new coins. And they called it an airdrop. That's not exactly what happens in real life, right? It's a very rare that would be very rare if that occurred. And so I just want people to understand that it's not exactly, it's guidance, but it's guidance that is going to be relied on in a very, very rare circumstance, which means it's probably not as helpful, which is why the New York State Bar Association has basically thanked the IRS for trying and then saying, please, not necessarily a do-over, but please, revise it to make it more like so people can figure out how to rely on the guidance.
Yeah. Was that part of their new sweeping recommendations that were released earlier this year?
No, that was actually when it came out in 2020. They spent a lot of time on hard forks because I think they realized that the IRS is just they're trying to keep up with all the changing stuff, but it's just a lot. It's a lot,
yeah.
And so I understand where the IRS is coming from. They're making an effort. They're just not quite there yet, and that's going to happen.
Yep. But as Justin had said, there is very limited guidance from the IRS regarding the taxation of virtual currency. And as everyone knows, in the last few years, there's been a huge push in decentralization and a whole economy built on virtual currency. And I'm looking at you, NFTs. And as a result, the taxation of virtual currency and these economies need to be addressed, which is why one of the great things that has happened recently is the New York State Bar Association has gotten together and provided sweeping recommendations on the taxation of virtual currency that will hopefully trickle its way down into the IRS and into Congress and find its way into law at some point.
Yeah, I agree, Rishi. And I think now what we should do is we should focus on, if this is property, if cryptocurrency is property, then what kind of property is it? And I think we're analyzing between two separate things. One is a commodity and one is a security.
Yep.
And this is not really, I don't think this is really an easy discussion. I do think that the analysis of looking at what we describe as the ordinary financial meaning, because the term commodity, funny enough, in the U.S. federal income tax, in the code, the U.S. Internal Revenue Code, is not defined. And so I think you have to look at, what is the ordinary financial meaning of the item we're looking at, and the IRS has, in the 70s, took a look at this basically. And I like what the IRS did. They basically deferred. Okay, we don't know what the ordinary financial meaning of an item is. So we're going to go look, and the Commodity Futures Trading Commission is who we're basically going to refer to for items in which we don't know what the answer is. And I don't know about you, Rishi. I actually thought that was probably the smart move, especially when it comes to things like cryptocurrency, where I think there's a lot of issues with people defining what it is.
Absolutely. You got to leave it to the experts.
Yeah, and in 2020, the CFTC, as they call it, did provide that all virtual currency is a commodity, all of it.
Yep.
Which I find interesting because in the tax code, there are certain sections in the tax code where they actually limit the definition of a commodity, whether if it's actively traded or
whether it's on the commodities exchange to begin with, right?
Yes, exactly. And so, I think that's probably a very good place to start, especially looking at it from what another entity in the government is doing, and because they're the ones that the CFTC is someone who's actively looking at commodities. Yep. And so it makes sense that they would have an idea of what a cryptocurrency should be. The reason why a security might be a tougher argument for what it is, for what cryptocurrency is because securities typically give you additional rights that I don't think a cryptocurrency would, for example. If I own Bitcoin, I don't own anything in addition to what that Bitcoin is. For example, if I own stock, equity, let's say, in a major corporation, not only do I own the stock itself, but I also have the rights to dividends. I have liquidation rights, voting rights to the corporations, presuming it's common stock.
Not to mention the value of that stock is not only dependent on what the market pays for it, but also dependent on the operations of the company that the ownership represents.
Yep, that's absolutely right.
And you don't have that situation with a Bitcoin or with a barrel of oil. It just is what it is. And two parties decide what that value is based on the market, based on desire, based on supply and demand. And that's the way it is.
Yes. Yeah. And we can also conclude that it's in most circumstances, I think, not debt. And debt you could define as an unqualified promise to pay, a sum certain on a specified date with fixed interest. That's basically, that's what debt is. And in general, most circumstances, I don't think cryptocurrency can be debt. It can be an item as debt, meaning that it's basically, if you're lending cryptocurrency, right, it's the item that you have to repay, let's say, but it's not debt itself. And I think the only argument to that as it possibly being debt is, I think, the stable coins, potentially, which the stable coins are like, they're pegged to the US dollar, for example. But in general, I think it makes the most sense. I think it makes the most sense to treat it as a commodity if we're going to say this is property and not a currency, for example. But I can definitely see the debate between the two of them. I mean, I don't know. Do you have any additional thoughts, or do you agree that it's probably the better answer is to treat it as a commodity?
Oh, I absolutely think it's a commodity, and I will say that as you've mentioned, Justin, that decision to treat virtual currency as a commodity does have sweeping tax implications across the code. For example, I mean, an easy one is the wash sale rules. The wash sale rules really apply to securities only. So if you're buying and selling virtual currencies within a 30-day period, you can take those losses and offset them against those gains because the wash sale rules only apply to security.
And that's true. Yeah, they're not. Yeah, and that's a huge benefit if you think about it. For if you're a cryptocurrency trader, is that you could. Well, now in particular, right? I mean, it'd really be beneficial now if you're sitting on a ton of losses because of the crypto crash. You could sell now, turn around and buy. Like let's say you had 10 Bitcoin. You could sell all your Bitcoin, take your losses, buy the Bitcoin now for the same price effectively.
Yep.
And then if the Bitcoin goes up in price, I mean, you're making out, whereas those wash sale rules for securities prevent that benefit.
Right. Assuming the IRS takes this position, which there is by no means an assertion there, but it seems appropriate given how Bitcoin has been traditionally treated since its inception.
Yes. So next, I think we should look at how the notice and the FAQ have also taken into account proof of work, which, without getting into detail, proof of work is how Bitcoin functions and how many of the other cryptocurrencies function, which is basically in order to verify that transactions on the blockchain are accurate, you have a node, one of the computers, basically, or several, I suppose, has to I think in simple terms, answer a very complicated puzzle or mathematical question or whatever it is. And to the extent they get the question correct, they then can verify the transactions on the blockchain and they get a reward and the reward is always in the, it's like if it was Bitcoin, they get Bitcoin, for example. The notice and the FAQs have both, given answers on this and have said that these rewards should be taxable as just gross income. Section 61, right there, you're getting taxed on it. You've done work. This is like, whatever you want to describe it as service income, whatever it is, it's taxable. The reason why this matters today is because cryptocurrency world is changing. And it's changing because proof of work requires a huge amount of energy, and people have decided that it's more efficient to use proof of stake. And proof of stake is effectively you decide you as an owner of a certain coin, and this coin uses proof of stake, you stake your coins for the right to basically validate transactions and validate transactions on the blockchain. And it's a random selection, theoretically. The more stakes you coin, the better chance you have of being selected. But then if you are selected, then you validate transactions. And typically speaking, you would get just most often, so I've heard, and I think you're going to agree with me on this, Rishi, you only collect the transaction fees. Every cryptocurrency transaction has a transaction fee. But in proof of stake, they don't frequently have staking rewards, meaning that you don't get coins in addition to your transaction fees. And so for sure, I think everyone agrees that that for whatever transaction fee you collect, that should be includable. The bigger issue under proof of stake is, well, if you're getting proof of stake and it's because of your ownership that you've been selected, whereas under proof of work, theoretically, anybody could answer the question correctly and do the work and get the coins. You don't have to be an owner of Bitcoin to do that. Under proof of stake, you would have to.
Yeah.
You'd have to be an owner. And so the question is it dilutive in the same vein as a stock dividend, whereas you're getting just more pieces of the pie versus, your pie went from, 8 slices to 12. And so now you're basically getting, instead of your 2 slices, you had 1/4 of the pie, you're still getting 1 total fourth of the pie, you just have 3 slices. Right? And so the question is, do you exclude that income, the staking reward potentially, because it's dilutive? And I think the answer there is harder. It's harder to answer. I don't view it quite the same as a stock dividend on the basis that if it's a stock dividend, then everybody who owns the stock is getting a stock dividend. If it's a staking reward, only the person who has been selected to validate the transactions is getting so-called the dividend or the reward for doing it. And if that's the case, I don't think it's a non-pro rata, right, dividend, which would mean that in this case you'd have to have some sort of accession to wealth. But I definitely think the answer isn't clear. But to me, it seems more likely it should be includable, like you would like a proof of work.
Yeah, and I think that's exactly right. I think, and that is a very debated question. I think if you just a quick Google search takes you to numerous articles, both of which fall on either end of the spectrum of whether it should be excludable or includable in income. And so I think until we see some movement from the IRS or from Congress, that sort of issue is going to be hotly contested and likely subject of a lot of litigation as the years progress.
Yeah, no, I definitely agree. And we're seeing litigation already in there because I know there's a case that's currently ongoing in, I think, Tennessee that's getting into that issue. Right. So finally, I think we're going to talk about crypto lending. And crypto lending has been a major talking point, not only, I think, in the tax community, but I think just anywhere in the crypto space, it's a big issue. And there is currently no direct guidance on whether a lender of cryptocurrency should realize any gain or loss in connection with making a loan of the cryptocurrency. And typically speaking, you'd be thinking, well, why does that make any sense if I'm loaning something? Most people would consider, you loan cash, right? And you don't think about it in any other way other than just lending. If you're, buying a car and they're, or buying a house and the bank's lending you money to buy the house, right? But there are transactions in which, for example, you'd lend securities as a classic example for shorting stock. A bank lends you stock, and then you short the stock, meaning you sell it, even though you don't technically own it. And you're banking on the fact that the price drops, and then when you have to fulfill the contract, you buy the stock at a lower price, you transfer the stock back to the bank, and you take whatever gains theoretically you've got from that because you bought at a lower price. So there's a code section in the Internal Revenue Code that protects the bank in this case from recognizing gain or loss when they lend that stock or security to you as the borrower, right? What's important about that is that section 1058, is limited to securities, which, as we talked before, if this is a commodity, then Section 1058 does not cover cryptocurrency. And the reason why that matters is because if you are lending cryptocurrency and you're not under the protection of Section 1058, well, then theoretically, if you lend any Bitcoin or Ethereum or Ether or whatever it is, you're going to recognize gain when you do that, when you have the lending transaction. Now, I don't know if people have been reporting it that way, probably because they think it'd be crazy to have that be the case, but that's realistically what the tax consequences could be. Now, the big debate is it appropriate to have Section 1058 be the point or be the code section that covers cryptocurrency, I think, Rishi. And I know there's a debate over whether it should be under Section 1001, under some non-recognition regulation or provision, or whether it's Section 1058.
Yep, and I think there's even proposed legislation out right now that tends to want to answer the question in favor of inclusion under 1058. But again, it's a hotly debated subject and one that I don't know, especially with this sort of schismed Congress, is ever going to get resolved in any sort of timely fashion.
I think that's right. And I think the big issue is that prior to Section 1058 coming out, there was the way these types of transactions work, where you lend these securities, is that they would be treated as like a deferred exchange. So you would lend, and then someone would basically promise you, I'm going to return to you, I shorted, let's say, GE stock. I'm going to return to you that identical stock, however many days down the road, whatever it is. And if it's a short, remember, it's a short time period, right? And then once you get the stock, once the lender gets the stock back, that closes the transaction. That's your exchange, right? When Section 1058 came out, they changed the timing of it. The timing became, now you have an immediate exchange. You don't have a deferred exchange. And the immediate exchange is you'd have the contractual right or obligation, let's say, to return the identical security. The reason why that makes a difference is because you can imagine a situation in which you would lend securities prior to Section 1058, and then let's say the stock price plummeted in value. So then what happens is the stock you get back is worth a lot less than when the stock you lended before. So you see there's a risk of gain or loss there that's involved in it, right? And so theoretically, Congress fixed that by making the exchange at the time of the obligation, right? They make the exchange at the time you have the contract, rather than around the time the stock is returned. And on top of that, the IRS issued regulations in there to try and solve these problems as well by, for example, having a 5-day rule where the lender could call back the stock within 5 days and you had to return that stock regardless of what happened. Right? More complicated in crypto. Don't have those rules. And in particular, these types of loans are term loans. They're not these callback loans, basically. So if they're 6 months long, well, then that's it. It's a term loan of 6 months. You got to wait 6 months. So in general, they're going to have to figure out the appropriate way to time this. Is it appropriate to do it the way Section 1058 is set up, to where the exchange happens on the date that you sign the contract that you're gonna lend, or is it on a deferred exchange? And if it is a deferred exchange, that's fine. I think the New York State Bar Association took the view that that's the better approach. But then you're going to need some regulations that help with the timing of this, so that you don't have an issue where the lender is bearing the risk of gain or loss.
Yep.
I think that also includes, Rishi, like the payments, like, the stock. If I lent stock, for example, and there was a dividend on the stock, right? That dividend is supposed to flow back to the lender. In the same vein, you think of this, you get an airdrop of coins. Most time these airdrops, by the way, have very little value. But to the extent that, if you want to set limitations and say, okay, if the value of the airdrop exceeds a certain threshold, you have to return that to the lender, maybe that's appropriate too. But it's just one of those situations where you're trying to fit cryptocurrency, which is like a square peg, into lending a security under Section 1058, which is around a round hole.
Yep. Agree.
I think, Rishi, this closes our discussion on taxation of cryptocurrency. We welcome any listeners to send us questions by email. We'll hope that you listen to these podcasts in the future.
Yeah. Thank you, everyone, for listening. Again, as Justin said, let us know if you've got any feedback, questions, comments. More than happy to continue what is going to be a very lengthy discussion over the coming days, weeks, months, and years with regards to cryptocurrency taxation. So thanks again. Talk to you soon.
Dealmaker Insights is a Reed Smith production. Our producer is Ali McArdle. For more information about Reed Smith's corporate and financial industry practices, please email dealmakerinsights@reedsmith.com. You can find our podcast on Spotify, Apple, Google, Stitcher, reedsmith.com, and on our social media accounts at Reed Smith LLP on LinkedIn, Facebook, and Twitter.
This podcast is provided for educational purposes. It does not constitute legal advice and is not intended to establish an attorney-client relationship, nor is it intended to suggest or establish standards of care applicable to particular lawyers in any given situation. Prior results do not guarantee a similar outcome. Any views, opinions, or comments made by any external guest speaker are not to be attributed to Reed Smith LLP or its individual lawyers. All rights reserved.